After putting in a high on April 4th, the Australian dollar has lost almost 10% of its value against the US dollar. Now, the break in the Aussie dollar was late compared to the declines in the euro and the yen, which began back in February. Many analysts attribute the relative strength of the Aussie dollar to the overall strength in commodities. Now, both the Canadian dollar and the Aussie dollar are viewed in the Forex world as commodity-linked currencies, with the Canadian dollar being more associated with oil and the Aussie more associated with gold. But overall commodity strength is ultimately good for both currencies. Australia, however, is more closely associated with demand from China, and the recent COVID lockdowns in China call that demand into question. This is all happening at the same time the Federal Reserve continues with a hawkish plan for U.S. rates, which should be supportive of the U.S. dollar. Now, if a trader believes that the weakness in the Aussie dollar will continue, they could express that by selling the June micro Aussie dollar futures contract at a current level of 0.7023 and target the 2019 congestion of 0.6850. Stop for this trade could be placed above at 0.7150. This trade could make $173 if your target is reached and risks $127 if you're stopped out of your level. Now, CME Group offers three sizes of futures contracts in Forex, the standard, the mini, and the micro, to match traders with their preferred risk tolerance. We're talking about the micro here. Now, if a trader believes that the Aussie dollar may bounce from current levels, they could express that by buying that June micro Aussie dollar futures contract at 0.7023 and target the April congestion at 0.7400. A stop for this trade could be placed below at 0.6800. This trade could make $377 if your target is reached and risks $223 if you're stopped out of your level.